the trader who read the market's hidden language. What if I told you that the most powerful signals on your chart are the ones most traders never learn to read? Not indicators, not moving averages, not some exotic algorithm written by a quant in a bank basement. Just raw candlestick patterns and the institutional story they tell every single session. I'm talking about patterns that reveal who is actually moving price, where they place their orders, and critically, when they're about to trigger a major move. More than 250 years ago, a Japanese rice trader named Homa Munehisa mapped the psychology of buyers and sellers into a system of visual candles. He reportedly built a fortune equivalent to billions in today's money, not by predicting the future, but by reading what the market was already showing him. What he understood, and what most modern traders still miss, is that candlesticks are not random shapes. They are records of intention. They show you where buying pressure came from, where it failed, where sellers stepped in, and where they ran out of steam. Every candle tells you something. Certain combinations of candles tell you something far more powerful. They reveal the footprints of large institutions. In this video, I'm going to show you 5 specific candlestick patterns that go far beyond the basic textbook stuff. These are patterns that reveal institutional accumulation and distribution, expose deliberate liquidity sweeps, unmask engineered false breakouts, and flag reversals before the retail crowd even begins to notice. Stick with me to the end, because the 5th pattern is one that catches traders out on a near weekly basis, and once you see how it works, you'll never look at it the same way again. Pattern 1. The Silent Army, 3-soldier accumulation signal. The first pattern is one I call the Silent Army 3 consecutive bullish candles that, in the right context, act as institutional fingerprints on the chart. Classical technicians know a version of this as 3 white soldiers, but the name is less important than the understanding behind it. These 3 candles are not just 3 green bars. They are evidence of sustained, organized buying pressure over 3 consecutive sessions. Retail traders do not typically produce this kind of structure. Retail buying is erratic. It spikes, pulls back, spikes again. 3 strong, clean bullish candles in a row almost always have an institutional hand behind them. Here is how to read each candle. The first candle. Buyers are stepping in tentatively at first, testing whether sellers can hold their ground. The body should be solid and meaningful, not a tiny sliver. The second candle. The buying pressure is building. Sellers are attempting to push back, but failing. The second candle opens near the first candle's close, confirming that buyers have maintained control overnight or across the session break. The third candle. Buyers have taken full control. Momentum is accelerating. The third candle tends to be the strongest of the 3. It closes near its high and opens near the second candle's close. Together, these 3 candles tell one coherent story. Institutions are entering. Follow them. Now context is everything. The Silent Army by itself is just 3 green candles. What transforms it into a high probability signal is the surrounding market structure. You are looking for 2 things before the pattern. First, a prior downtrend or a meaningful pullback evidence that the market was oversold or that sellers had been in control. Second, a period of sideways movement, a base, or a consolidation zone, evidence that accumulation has been taking place. The pattern does not need to be textbook perfect. What matters is that 3 consecutive bullish candles appear at a point where the structure suggests buyers are taking over from sellers. On XAUUSD gold versus the US dollar on the daily chart, the Silent Army has appeared repeatedly at key structural turning points. A textbook example. Price had been trending lower for several weeks and compressed into a base around the $2,290 level. Sellers stopped making lower lows the the first sign that bearish momentum was fading. Then 3 strong bullish candles formed, each with a solid body and closing near its high. Directly above them sat a clear resistance level. The confirmation signal came when the third candle itself broke cleanly above resistance and closed outside the prior range. Entry at the close of that breakout candle. Stop loss just below the broken resistance level. Target at the next significant resistance. That trade delivered a 1-to-5 risk to reward on the initial setup, and a second silent army formed mid-trend on the continuation, offering an additional 1-to-9 before price showed signs of exhaustion. One more example worth noting. On Ethereum versus the US dollar on the daily chart, the silent army formed right at the point of a range breakout. The market had been moving sideways for an extended period. The 3 bullish candles appeared simultaneously, with the breakout above the top of the range, and crucially, the third candle was the candle that closed outside the range. That is the highest quality version of this setup. Because the breakout is happening while momentum is already at peak, you are not waiting for lagging confirmation. You are entering as the move accelerates. Result: a 1-to-7 on that trade before price pulled back to consolidate again. Pattern 2. The institutional dump. 3 bear distribution breakdown. The institutional dump is the mirror image of the silent army. But instead of institutions accumulating, they are distributing. 3 consecutive bearish candles, each with a solid body, each opening near the prior close, each closing near its low. This pattern reveals a systematic handover of supply from institutional sellers into retail buyers, smart money exiting while retail money enters, before price moves aggressively lower. The setup requires the same contextual awareness as the silent army, but in reverse. Before the pattern, you need an uptrend or a clear range-bound market that has tested a significant resistance level multiple times. Repeated tests of resistance without a breakout is a warning. Buyers are weakening. Then the distribution phase begins. Price moves sideways as institutions quietly sell into retail buying. And then the 3 bearish candles appear. When the third candle breaks below a key support level and closes beneath it, that is your entry. Stop loss goes just above the broken support, which now acts as resistance. Target is the next significant level below. On NZD-USD, on the daily chart, the pair had been trending higher and hit a defined resistance zone around 0.615 3 times without breaking through. Each test saw buying activity dry up faster than the last, a sign of distribution. Then the 3 bearish candles formed, and the third closed below a major support level. Entry at the close, stop above broken support. The result was a 1-to-9 move lower before the next meaningful support held price. The quality of this setup came from the confluence. 3 resistance tests, a clear distribution phase, and the institutional dump providing the timing signal. On GBP-USD daily, the institutional dump, combined with a trendline break, created an even stronger signal. The pair had been trending higher, respecting a clear ascending trendline. A double top formed 2 highs at the same level, with momentum visibly weakening at the second high. That is a structural warning. The trend is running out of energy. Then, the distribution range began. 3 bearish candles formed, and the third candle broke below the ascending trendline and closed beneath it. When the institutional dump and a trendline break coincide, you have 2 independent signals confirming the same message. Buyers have lost control. Entry at the third candle's close, stop above the trendline, target at the next significant support. That trade returned 1-to-7. Quick pause here. If these breakdowns are giving you something useful, a like genuinely helps push the content to more traders. Right, let's get into the next 2 patterns, because these are where the real edge lives. Most traders get frustrated by these setups. Once you understand the mechanics, you'll realize the frustration is the pattern working exactly as intended, just not in the direction you were hoping. Pattern 3. The twin hammer trap. Double liquidity. Sweep. Bullish. Here is a scenario that most traders have lived through at least once, and most have never figured out what actually happened. You spot a hammer candle at a key support level. The wick punches below support, the body closes back above it. Classic liquidity sweep. You buy the close, place a tight stop below the wick, and then the market drops again, takes out your stop, and then rallies without you. You feel robbed. What you experienced was not bad luck. It was the twin hammer trap, and it is a very specific, very deliberate institutional pattern. Here is what is actually happening beneath the surface. After the first hammer, institutions have begun buying, but they need more liquidity to complete their full position. Think of it this way. A large institution cannot enter a multi-million-dollar position in one candle without moving the market significantly against itself. So they use a two-step process. The first hammer collects some of the available liquidity. Then they allow price to drift back down, triggering the stop losses of everyone who entered on that first hammer. Those stops hundreds or thousands of contracts, depending on the market, are the liquidity the institution needs for the second phase of its entry. The second hammer, with its wick sweeping below the first hammer's low, is the institution completing its position. The professional response to being stopped out on the first hammer is not frustration, it is recognition. When you see the second hammer form with its wick below the first hammer's low, and then close back above the support zone, you have confirmation of the twin hammer trap. That is the actual entry. Stop goes below the second hammer's low. Target is the next resistance level above. The risk to reward on the second trade is often better than the first would have been, because your stop is tighter relative to the size of the move. On AUDJPY Daily, the twin hammer trap appeared at a key support area and launched a strong multi-day rally. On GBPJPY, a similar pattern at the 192 zone delivered over 350 pips before price found the next major resistance. One practical note on how to manage the first trade when this pattern is in play. Some traders use a slightly wider stop on the first hammer, placing it below the prior swing low rather than below the hammer's wick. This occasionally means surviving the second sweep without being stopped out, at the cost of a worse risk to reward on the first trade. More common, and in my view more practical, is to treat the two hammers as a sequential system. Enter the first with a normal stop, except that you may be stopped, and immediately look for the second if it forms. Do not double position on the first hammer in anticipation of a second sweep that is speculation on a pattern forming, not a pattern that has formed. Pattern 4. The bull trap twins. Double liquidity. Sweep. Bearish. Now flip the entire logic. The bull trap twins is the bearish counterpart to the twin hammer trap, and it works on exactly the same principle. Institutions engineering two liquidity sweeps before a significant move. But this time, the move is downward. At a key resistance level, a bearish pin bar appears, a candle with a long upper wick that breaks above resistance and closes back below it. Classic short signal. The eager sellers enter, stops placed above the wick, and then the market drifts higher and forms a second pin bar with a wick that reaches above the first pin bar's high. Stops are hit. The market reverses and drops hard. That is the bull trap twins. The mechanics. The first pin bar sweep collects liquidity from the obvious stop-loss cluster above resistance, the stops of traders who went long into the resistance zone. The second sweep then collects the stops of the sellers who entered on the first pin bar. After 2 rounds of liquidity collection, institutions have the fuel they need to push price aggressively lower. The entry is at the close of the second pin bar, once it has confirmed a close back below the resistance level. Stop goes above the second pin bar's wick. Target is the next significant support below. This is a high-quality setup when it occurs in a broader downtrend or at a resistance that has been tested and rejected 3 or more times. On USD CAD daily, the pair had been trending higher before entering a well-defined range, testing the top of that range 3 times. A strong bearish pin bar then formed a first sweep above resistance. Sellers took the trade, stops above the wick. The market then ground higher one more session and formed the second pin bar with its wick punching above the first. Second set of stops hit. The market then dropped immediately and aggressively from that second sweep, delivering over 1-6 on the trade. The lesson: do not give up on the short thesis because the first signal failed. The failure was institutional, and the second pin bar told you exactly when to re-enter. On USD CHF daily, the pair had been in a clear downtrend. Price bounced to a resistance level, the former support that had broken to the downside, now acting as resistance. A bearish pin bar appeared at that level, classic break and retest with a liquidity sweep. But then a second candle with a long upper wick formed and hit the stops of early sellers. That second wick above the same resistance level, the bull trap twins, was the signal entry at the close. The subsequent drop was decisive and well-sustained, confirming that both sweeps had genuinely collected the liquidity institutions needed. In a strong downtrend, the bull trap twins at a break and retest is one of the cleanest setups available. Pattern 5, the fakie setup, inside bar false breakout. The fifth and final pattern is what price action traders call the fakie setup, and it is, in many ways, the most elegant of the 5. It is built on the inside bar, a candle whose entire high to low range sits within the range of the preceding candle, which we call the mother bar. The mother bar is the frame. Its high becomes a resistance level. Its low becomes a support level. The inside bar represents a period of genuine compression buyers and sellers in near equilibrium, the market coiling before its next significant move. Most traders who are aware of inside bars watch for the breakout. When price pokes above the mother bar's high, breakout traders go long. When price dips below the mother bar's low, breakout traders go short. The fakie setup is what happens when that breakout is a trap. Price breaks one side of the inside bar range, triggering breakout orders and triggering stop losses on the opposite side, and then snaps straight back inside the range. The breakout traders are now holding losing positions. Their stop losses are sitting outside the range they just re-entered. As they scramble to exit, they provide the momentum for the real move in the opposite direction. A bullish fakie. The market breaks below the mother bar's low. Short sellers take the bait and go short. Long trader stops are hit, and then the candle closes back inside the inside bar's range. You enter long at the close of the false break candle. Stop loss goes below the wick of the false break. Target is above the mother bar's high, or the next meaningful resistance level. The bearish version is the exact mirror. False break above the mother bar's high, close back inside, enter short, stop above the false break wick. On USD/JPY 4-hour chart, the pair had pulled back into a clean support zone around 152.5. A mother bar formed with a meaningful range. Over the following sessions, 2 inside bars compressed within that range. The market was coiling. Then a candle broke below the inside bar's low, stop hunts fired. Short sellers entered and closed back inside the pattern on the same candle. Entry at the close of the false break candle. Stop below the wick. The market then rallied cleanly to the next resistance, delivering just over 1 to 4 on the trade. Simple, clean, and repeatable. On the 4-hour and daily charts, this pattern appears regularly at confluence zones, high-quality support, or resistance that has been tested previously, combined with the inside bar compression structure. A nuance worth understanding. The fakie does not have to be one inside bar. Sometimes price compresses over 3, 4, or even 5 sessions inside the mother bar's range before the false breakout fires. The longer and tighter the compression, the more traders have had time to position their breakout orders at the obvious levels, which means a larger liquidity pool for institutions to harvest when the fakie fires. Extended compression fakies tend to produce more explosive moves. When you see 5 or 6 candles compressed inside a mother bar, treat the eventual false breakout with extra attention. The thread that connects all 5 patterns. Let's pull back and look at what actually connects these 5 patterns. It is not the shape of the candles. It is not the number of candles. It is the story they tell about institutional behavior and how that behavior creates tradable opportunities for those who can read the market's language. Every one of these 5 patterns is, at its core, a footprint, evidence that a large player has been active and is either beginning or completing a significant position. The silent army. 3 consecutive bullish candles revealing institutional accumulation follow them up. The institutional dump. 3 consecutive bearish candles revealing institutional distribution follow them down. The twin hammer trap. 2 bullish liquidity sweeps in sequence, with the second one completing the institutional position. The first stop out is the price of admission to the real trade. The bull trap twins. 2 bearish liquidity sweeps in sequence at resistance. The second confirming institutional intent to push lower re-enter after the second sweep. The fakie setup. An engineered false breakout of an inside bar that traps retail breakout traders before the real move fires enter in the direction of the snapback. The skill that ties all 5 together is structural awareness. Before any of these patterns has meaning, you need to know where you are in the bigger picture. Are you in a trend or a range? Are you near a significant support or resistance level that has been tested before? Is the pattern appearing after a period of accumulation or distribution? A silent army in the middle of nowhere is just 3 green candles. A silent army after a double bottom at a major support level following a 2-month downtrend is a potential institutional reversal signal. Context is not a filter you add to the pattern, it is the foundation the pattern stands on. Halman Munehisa did not build his fortune by finding the perfect indicator or by predicting where the market would go. He built it by reading what the market was already doing, the imbalances between buyers and sellers, the moments when accumulation was giving way to trending, the signals that revealed when large players were active. These 5 patterns are tools for doing exactly that on a modern chart. They are not a mechanical system to follow blindly. They are a language to learn, and the more fluent you become, the more clearly you can read the intentions of the players who actually move price. If this video gave you something you will genuinely use in your trading, subscribe and turn on the notification bell. I post a new breakdown every week. Next week, I'm going deep on supply and demand zones, how to draw them correctly, how to grade them by quality, and the one key filter that removes the majority of false signals. If you trade off key levels at all, you do not want to miss it. See you in the next one. Not financial advice. Trading carries risk. Never risk more than 1 to 2% of your account on any single trade. Manage your risk, protect your capital, and I'll see you in the next one.